Good morning, everyone. Thank you for taking the time out to join us. We do appreciate it. So without further ado, Rob and I have been with the business now for about 3.5 years. It's been a really great experience for us to put IDOX back into a strong position, both operationally and financially. And we're really pleased to report another strong financial performance and a time of good strategic and operational progress in FY21. So for those of you who know as well, you know that we have a real strength in engineering and also in the public sector operation, where over 90% of UK local authorities are customers of ours for one or more products. We have over 1,200 customers and over 600 employees now, principally in the UK, but also in Europe and India. And we have a really strong operation generating strong revenues, strong recurring income, and strong EBITDA margins of over 30%. So what we'll do is we'll take you through some of the highlights, the financial review, where I'll hand over to Rob. I'll take you back through strategy and operations. Rob will look at our M&A strategy going forward. I'll talk a little bit about ESG and our credentials there and about the future outlook for the business. So the highlights in financial year 21, as I say, is that Rob and I talk about this a lot internally, and of course, our view is that on occasions there's not a lot you can do that sometimes to affect your in-year financial results, but what you can do at all times is improve the quality of your business and the quality of your operations, and that invariably leads to good results over a protracted period of time. And as we've concentrated through our 4 pillars program and our 3 phases, which we'll come on to, we have managed to see an improvement in our revenues in year. They're up by 9%. Our recurring revenues increased by 2% in the year. Our adjusted EBITDA was up 13%. And we're really pleased to further reduce our debt, and that's down by half over the course of the year. It was also a busy year. In February of last year, we had an inquiry about the business, as you'll recall, from Dye & Durham. And on top of that, we disposed of our content business, which was based in Germany and Holland, in 2 separate transactions. And we recycled that cash to acquire 3 very strong public sector software operations, which add significantly to our capabilities in our core operational areas. So really pleased with the activities during the course of the year. And as I said, we're very clear that we have 4 pillars, which we'll come on to, and 3 phases. Those of you who, as I say, have been following the IDOX journey will know that we move through our work on run phases. We feel we're very much into our fly phase now. So having established all of the core operating activities in the business and improve the way that we manage the business, we now feel we've set the foundation blocks in play to be able to grow the business organically, consistently, single mid-digits, and also to be able to add to our portfolio through very targeted M&A, to be able to add to our product portfolios and to increase the scope and the range of our software products that we can offer to existing customers. So it's our aim over the next period of time to push the business on, hopefully to get towards £500 million market cap, and to do that by establishing a business which follows the rule of 40 principle. So mid-single digit growth, 35%, around 35% margins, to give us a rule of 40 business and to show a consistent move forward. And we'll do that by focusing continually on cloud and SaaS operations, focusing always on margins. We know as a business that it's sometimes very easy to grow a business, but it's much more difficult to ensure that you don't lose or leak those margins. So we focus on operational excellence to ensure that whatever we can throw through our revenue line also works to come through at the bottom in terms of improved profits and, importantly, improved cash. And as I say, we'll look to grow the business both organically at mid-single digits and add to the business, leveraging our good position with cash to fund new M&A activity of the like that you've seen this year. And we'll have a small review of that as we go forward, so that you can see the types of businesses we're bringing into the portfolio and also see the effect that they can have on both our top and bottom line. So with that, I'm going to hand over to Rob, and he's going to take us through the highlights of the financial review. Thanks, Rob.
Yeah, thanks, Dave. I think as ever, you stole all of my good lines, so thank you for that. But yeah, morning everybody. This slide quotes the financial highlights from our announcement today, which hopefully everybody's had an opportunity to see. So revenue is up strongly, which we'll shortly see as we move through the slide deck, as a combination of PSS division having a really strong year, albeit that's mitigated somewhat by our EAM business, which continues to see some market headwinds. And again, we'll come on to some of those reasons. Recurring revenue increased quite nicely in our PSS business, assisted by the contributions of our 3 excellent acquisitions in the year, which we are really pleased with, but we'll come to and provide a bit more detail with that. And we're really pleased with the EBITDA result in the year. Up 13%, I think, is a really strong result for any size or shape of business, quite frankly. And it's largely due to the better quality of revenue and ongoing cost control, which are clearly themes that we've been talking about for a number of years now, both in terms of sort of sales governance, improving revenue mix and revenue quality, but also sort of proper financial discipline just in the day-to-day operations of the business, alongside the key strategic decisions as we look to scale the business both organically and inorganically. Similarly, as we move down the P&L, and again we'll come to this with a bit more detail, but earnings per share, fully diluted adjusted earnings per share, is up strongly, up 54% on a fully diluted and adjusted basis, which is a pretty incredible number, and it reflects the strong drop of the sort of EBITDA contribution that just referred to. That was assisted by the FX on our 6 billion bond, which again we'll come to shortly. And net debt continues to topple down and is now a pretty modest figure for us, quite frankly, in the context of our earnings power. So net debt has halved in the year, and actually, if you sort of wind back to where this journey started for Dave and I towards the end of 18, start of 19, there's actually a quarter of where that figure was then. So it was well over 30 million at that point. And actually, when you strip out our bond, which is about 11 million balance, we have a net cash position with our banks around 3 million quid, which when you sort of combine that with the available RCF of 35 million, we're extremely well positioned to capitalise on our accretive M&A, which again we'll come to. And finally, we're really pleased to announce, following the reintroduction of the dividend last year, that we're continuing to ramp that up year on year in line with a progressive policy that we've talked about before. So up 33% year on year. And again, I think we've been very clear that the strategy for the business is to use excess cash generated to go and build shareholder value, both through organic investments, but clearly buy and build. But we do see the payment of dividends as a good sort of hygiene factor, really a good sign of good financial discipline along the way. So as I noted in my introductory slide there, we did see a good performance in public sector software, really across the portfolio, for most sort of product families, but in particular our local authority regulatory services division, which includes IDOX Cloud. So this is our sort of core of planning, building control, and public protection application software. Saw a very strong year. We saw good levels of order intake in the year as we just sort of increased demand from existing customers as they were looking to us for more support with their existing deployments, particularly as they themselves were sort of getting squeezed in terms of headcount. And we talked previously about our sales stratification. We've had a full year now of both our inside sales team and our revenue assurance team, which we'll come to. So we've been extremely well positioned to capitalise on that interest, and during the year I've run a number of marketing campaigns which have directly underpinned the increase in services orders that we've seen. Noted our acquisitions obviously had a big part to play in the year. You'll probably be pleased to know there's no content slide in this deck anymore. It is just PSS and EAM. But in terms of PSS, acquisitions contributed around 1.8 million of revenue in the period, and we'll come to some of the run rate figures shortly. But taking that out of the picture, the PSS division delivered an underlying increase of 5.5%, which we're really pleased with, and is directly in line with our sort of previous and ongoing guidance. And this increase in revenue dropped really strongly through the P&L. Again, to my earlier comments around good cost discipline. I mean, we are investing across our business, just to be clear. We're investing in a number of areas, not just R&D, but also investing in people throughout our business. But we're doing that at a sensible pace and doing that in a targeted way, and certainly in line with our planned growth. So, as I say, revenue dropped very strongly through the P&Ls. We saw EBITDA up in our PSS division by 2.5 million to 18 million in total. So on to EAM, and again, as noted in my introductory remarks, really, I mean, EAM did continue to see market headwinds during the year across its sort of historical oil and gas markets, but more generally across the large infrastructure type construction sectors, which have obviously seen quite a slowdown with some of the COVID restrictions, particularly throughout the back end of 20 and 2020. Generally, consumption driving lower levels of activities during those periods. We have seen that start to reverse recently, which I think is helpful, and we can all sort of see consumption generally starting to tick up as restrictions around the world do start to drop, and we've seen numerous sort of positive engagements just in the last 6 months, which we see as very positive data points actually for the large scale construction generally, that those guards are open for business, and for us as ever provides a good opportunity. I mean, we always remain extremely confident in the EIM business, not just the existing installed base, but the continued interest for the new SaaS-based Fusion Life products. So, whenever we see a change in the market in our favour, we feel very well positioned to execute on that. Despite that revenue decrease that I mentioned, there was about a 9% revenue decrease. We actually made a lot of progress in integrating EIM into the core of what we now call IDOX software. So this time last year, we were talking about separate divisions, PSS, EIM, and content. We now largely run PSS and EIM as a single IDOX software business. And you can see that really coming through in the margins that we managed to really keep stable despite the decrease in revenue. So it's actually shown as a 0.1 on this slide, but that's unfortunately a sort of consequence around it. We actually stayed relatively flat year on year. And again, it's a really good opportunity for us going forward as we do see the market start to improve and our ability to capitalise that. Again, EIM is very well placed both from a revenue and from an earnings point of view. Moving on to the primary statements, I think most of these are fairly self-explanatory and probably repeating things that we've covered, but every line pretty much on the income statement has seen very strong year-on-year increases, either in line with or in excess of what we've talked about at an adjusted EBITDA level. We had no material restructuring or refinancing line items. Those of you that have tracked IDOX for a few years will know we had a fair few of those, particularly in FY19, as the business was being reshaped, and to a lesser extent some of those in 20. We had none of those in FY21, and whilst we did do a financing extension, we largely did that within our own means. The other thing to probably flag, as I mentioned at the start, really, was we did see a helpful 0.8 gain for our IDOX, for our 6pm Maltese bond, which we still retain through to its maturity date in 2025. So that was largely a consequence of the beneficial FX movement, because that's a euro-denominated bond. Moving on to the balance sheet, again, largely in line with prior years and certainly in line with what you'd expect really from an IP-led software business. So a large amount of intangibles, both from sort of previous periods, R&D capitalisation, but also acquisition, a bunch of working capital, and then clearly deferred income for subscription invoices in advance. Probably the most interesting thing to pull out really is the VAT deferral. So as with most businesses, indeed, I think as with every business in the UK in 2020, we took the government up on their offer to defer the VAT bill interest-free, which happened to coincide with an invoicing peak for us. So it was a very helpful number. So whilst we deferred VAT of around 3.8 million in FY20, that's been largely repaid. Now we paid 2/3 of that in FY21, with the balance being paid over the coming months. I think actually January is the last month. So you'll see that as a large working capital swing in the numbers, but excluding that, cash conversion continues to remain very, very strong for IDOX, and consistent with previous periods, and certainly no reason to think that won't continue going forward. All the other movements largely attributable to our acquisitions and disposals in the period. I mean, the obvious one is in the intangibles line, where we recognise a bunch of intangible assets associated with the 3 businesses that we brought on. And then a handful of sort of debtor and creditor type balances through a combination of deferred consideration, earn-outs, a small bond payable on one of the disposals, and of course a slightly different profile of the actual working capital balances as we've disposed and then acquired different shaped businesses. Then moving on to cash flow again, at the risk of sounding boring, in line with prior periods, with the one notable exception, really, the VAT deferral mentioned previously. I guess the other notable thing is we have largely or significantly reduced the actual drawings that we have under our facilities. So at the time of the initial sort of COVID hits back in 2020, we took the decision to fully draw our facilities as part of our defence, which again a lot of businesses did. As it turned out, IDOX proved extremely resilient throughout that whole period, and so during the year took the decision to repay that to the extent that we didn't need it. And so it doesn't affect net debt because the whole thing gets netted off the net debt. The excess cash versus the higher debt balance still gives you the same net debt balance, but in terms of the gross figures, they're lower constituent figures, and obviously lower RCF drawing equals slightly lower interest versus commitment fee. And as I mentioned at the start, if you were to exclude the 6pm bond, which is largely a static balance for us, to be honest, aside from the interest we pay every year, we actually had net cash in hand of around 3 million at the end of the year, which with our RCF 35 million and 10 million accordingly available leaves us very well capitalised to progress with the buy and build strategy. Moving on to future guidance slide, which I know quite a few people find quite helpful. Probably just wanted to flag at the outset, really, that this hasn't really changed since last year, which I guess is helpful for everybody involved and really is a sign to the stability of the IDOX business. I'll just run through the boxes from an organic growth point of view. We continue to think that mid-single digits is the right guidance for our public sector software business. That reflects the underlying trends that we see. We are continuing to see good service requests from our customers and continue to work very hard on CPI and also increasing market share. But the reality is the markets do churn relatively slowly, so we think mid-single digits is the right guidance. Similarly on EIM, notwithstanding my more positive comments earlier on, again, mid-single digits feels the right figure for EIM. We remain optimistic that we'll outstrip that for all the reasons that I previously outlined, but in terms of guidance, that's mid-single digits feels like the right place. And margin-wise, Dave touched on it in his slide, so we are continuing on the path to increase margin. We saw EBITDA margins tick up 1% in 21 versus 20, and very much expecting to continue that path through to the goal of around 35 through a combination of just doing a bit more internally, particularly as we scale the business organically, just getting a bit of a better mix. And of course, acquisitions are very important for us. We'll see as we come through, but our ability to scale those businesses at very high margin actually is relatively material for the IDOX group as a whole. In terms of non-trading items, as I mentioned, very little to no restructuring and refinancing costs in the year. I've touched on sort of cash conversion and ongoing liquidity. As I mentioned, really pleased that we've been able to increase the dividend by a third, which I think is a pretty good figure by any measure, and certainly in line with our previous comments around a progressive dividend policy. And the final comment really is just a bit of blue, just to confirm for the avoidance of doubt, we are very much on plan for the year. So we're approaching our quarter end. Year end is long behind us and quarter end closes in 3 days. So always something to do, but today very much on plan and no reason to think that we won't be on plan for the full year. And I think that's me. If I can pass back to you, please, Dave.
Thanks, Rob. As Rob's pointed out, a great year of sort of execution coming through in the financial results, really. And I think hopefully people who follow us find us really consistent on an ongoing basis. Having defined the strategy, most of our time now is just in the operational execution. So, hopefully the strategy is clear and, it allows us just to focus day to day on the things that sort of empower that strategy and make it effective. And as I say, I think we're pleased with this set of results because it just shows that strategy has played out very well. Good quality improvements right across the business. I think a real advancement in our M&A strategy, the disposal of the content business, 2 good businesses there that we sold, but appendages really to the ongoing activities within the group. And so it's been great to find those good new homes for us to, as we said, recycle the cash to bring in assets that we think are of higher quality with the assets that we also have in the group elsewhere. So the acquisition of aligned assets, Thinkware and Exegesis, really offered us a much greater focus and depth of experience in our core operating markets. and gave us access to near adjacencies and some really good depth of understanding and knowledge around GIS. And as we know, where clients are looking to improve the way that they display and promote engagement, then that is a really significant asset for us to bring into the group. Rob and I have continued to spend, because we've got a good operational team here at IDOX. Jonathan Legdon, our COO, runs a great team of people. And so that's allowed Rob and I to spend a little bit more time developing out our M&A efforts in both sourcing and managing pipeline opportunities. And Rob's going to come back and talk a little bit about those in a couple of moments. We've continued to work on our CRM. I think everyone's familiar with the work that we've done there. During the course of this fiscal, we'll seek to put our professional services work also alongside the work that we've done in our sales aspects with Salesforce. And that will continue to improve the quality of the work we're able to do for clients and the visibility of the transactions that we engage with them on. One thing I'm also really pleased about in the course of the last 12, 18 months has been our focus on where we actually engage in our offshore activity. When we first arrived here at IDOX, there were several small development activities offshore in lots of different locations, and that really didn't make any sense. We've been able to bring all of our activities together into one centre now in Pune in India. Kailash has joined us to run up that facility. And indeed, I think probably about half of our hiring plan during the course of FY22 will be to build out on a larger basis our activities out in Pune. We are continuing to focus on innovation and the way our products work for clients, and particularly, as we said, the movement to the cloud. And we've also invested really heavily in our people here at IDOX. We had just over 30 people go through the IDOX leadership program last year. This year in 22, we'll have about 70 more people go through that program of work. And so, we're actually investing to be ready for the growth that we see coming through in the business. We'd like to believe that in the majority of cases, leadership of our new activities can come from the people that we already have here in the business. And so it's been quite exciting for us to see so many people engage in a meaningful way with the business and want to progress their careers in that way. And of course, environmental, social, and governance aspects, I know are very hot for lots of investors, but they're also, very important to the customers that we're serving. And so we feel it's really important to reflect the emphasis that they're putting onto those things within our business, and also to reflect the type of activities that people who work for IDOX want to see an IDOX governance operating under. And so I'll cover that a little bit later in the deck. So everyone on the call know about our 4 pillars of revenue expansion, gross margin improvement, simplicity, and communication. I don't intend to take you heavily through this slide. I'll just pull out a couple of things because I think they're significant. We've now got everyone within our group managed via our CRM. I think that's really important. The acquisitions as we bring them on board, it's one of the things that we prioritize to try and pull through and ensure that we get a really good comprehensive view of how that works. And that allows us immediately to add a little bit of value to the acquisitions that we bring on board. In terms of our gross margin improvement, I think we've made some really great progress on our data conversion processes, but also in the release of new products like LilyHub, which is a SaaS self-service platform for the sexual health product that we have, which operates across the health sector. In simplicity, we're just constantly chipping away at things that we feel are unnecessary or an administrative burden, or create blockages in the business, and that continues at a pace. And on the communication front, we've spent quite a bit of time looking at ways in which we can improve our customer communication. I think you'll have seen a lot of improvements in our branding over time, certainly thinking about, the IDOX Do More rebranding that took place a little while back. And we've stepped up the level of white papers and engagement that we have to do a little bit more thought leadership and try and get to help our customers understand those challenges and trends that are coming down the road, such that, they're well placed to deal with them when they do actually arrive. And with that, I'm going to hand back to Rob, who's going to talk about elements of the fly phase and what we can do for our buy and build strategy.
So we presented this slide before, so hopefully it's relatively familiar to the group. But as we sort of commented on our walk, run, fly terminology, we can now consider ourselves firmly in the fly stage of our progression to still one of Dave's lines. We can see our feet lifting off the floor. And so for us, really, that's two sort of big bodies of activity. Clearly, it's continuing to grow the business organically and specifically through bolt-on acquisitions, which we'll come to shortly. In terms of the growing the business organically, I mean, Dave just sort of covered a few really interesting anecdotes there. It remains a constant topic of discussion throughout the business under these various headings, which will broadly get organised under our 4-pillar strategy. And as I sort of mentioned, we remain focused on scaling our business through buy and build as we look for well-respected but often subscale businesses that we can source and bring into the IDOX group to use our collective resources to grow. So we provided an update to this previous slide that we presented. I think half year was the first time we did it in respect of our Tescomi acquisition. So for most people, I think they'll know that was our first acquisition back in July 19. And we've since rebranded that IDOX Cloud, as I mentioned before. This provides sort of cloud solutions in the local authority regulatory services area. This slide demonstrates, there's really good opportunity for these sort of, dare I say it, subscale businesses, but certainly well-respected products in their niches. There's really good opportunity to develop these businesses and provide various streams of support from IDOX across a number of strategical but also sort of operationally practical areas that IDOX can bring support and focus. And the coloured arrows on this slide, I think, are really good indications of some of the day-to-day, week-to-week things that we can bring, as well as the more sort of conceptual support around strategy to both support the local teams to get more product in front of more customers, but also where needed to help deploy capital to accelerate things. Yeah, we really like this slide. We think the slide's good evidence of when things go really well with sourcing, acquiring and managing these businesses, and of course we're very pleased to have done 3 of those in FY21, which we've done a summary for on this slide, with very brief details about what the businesses do and their broad sort of sizes on an annualized basis. So these are effectively the annualized run rates coming out of FY21 going into FY22. And we're really pleased with these 3 acquisitions. Obviously, we announced each one of these in the year. So if you do need some more information, feel free to dig out some of those announcements. But in each case, it's proven. It was anticipated to be, and has since proven to be, a really strong combination, both for IDOX and the sellers, but also for our sort of collective customers and people. We've sort of proved time and time again IDOX is a really good home for these businesses, both in terms of taking them that step further for the existing staff and customers and the products, but also for the owner managers, whether they're looking to stay in the business and bring their experience and knowledge to bear, and with IDOX's support take them to the next level, or indeed looking to exit for personal reasons. And again, we feel like we can sell a very strong proposition that IDOX is a very good home for those businesses. And we're really pleased that the capital values that we've achieved for these businesses, we feel this represents good use of shareholder capital, and in particular we've been able to structure a couple of deals in a way that makes a lot of sense for the seller as well as for IDOX. And again, think this is a really good use of our capital, particularly in the year that we have sold those 2 content businesses. We actually ended up net cash neutral across all 5 transactions, which was helpful. So yeah, really sort of pleased with that process. The only other sort of thing I'd mention on capital value is it's interesting. It's almost more interesting what's not on this slide. So we're very pleased with the 3 that we secured in the year. But of course, as Dave's alluded to, there is a whole pipeline process behind this, and a number of opportunities that are at various stages, including some that are relatively well developed. But we have had numerous examples where the conclusion ultimately has been that the product fit isn't quite right, or indeed that the capital value just doesn't work for us. And we're pretty confident in our own abilities, in both in terms of operational execution, but also in our M&A sourcing abilities, that we can hold the line quite rightly on those sorts of discussions. And so therefore, the ones that do come through for completion, we're really pleased with both how they bring new products and skills into the IDOX group, but as I say, with the capital levels that we've paid. We've also included a slide this time on integrations. It seems a fairly obvious question given the volume of acquisitions we're now doing. And of the 3 acquisitions, we've made really good progress with the integrations and certainly remain on plan for all 3. So as you can see from the circles, which I know Dave's a particular fan of, we've completed the migration of people and back office functions to IDOX systems, so both aligned assets and thinkware. So that's everybody, customers, staff, and suppliers within the IDOX statutory company on IDOX T's and C's. And we're in the process of completing that for exegesis, which will complete over the coming weeks and months. From a commercial point of view, the 3 transactions are at slightly different stages, which is what you'd expect given they've happened at different points in the year. In the case of aligned assets, we've completed the sort of go-to-market alignments and largely completed the technical product integration, with a few remaining technical integrations that I know are due to complete over the coming months. In the case of thinkware, we're still working with our teams to fully embed the commercial approach, particularly for new business, but the integration of the product is extremely well developed. In fact, it's largely complete, and I know the GIS platform and team have settled very quickly into our broader sort of technical and products, land and property efforts. And finally, exegesis, similarly being adopted into our land and property GIS efforts, GIS being Geo Information Systems, by the way. And the £500,000 just reflects, where we are in the process. So we closed the exegesis transaction in October, so 3.5 months on, excluding Christmas. We've done a great deal, a bit more to do, but in summary, exactly where we thought we would be at this stage. We touched on some of these themes before, but again, a brief summary really of the types of businesses we're looking for as part of our buy and build strategy. The goals are unchanged. We've used this slide before, and having gone through the exercise numerous times over the last 12 months, not just with the 3 that we've closed, but as I've said, the others that we have decided not to. We're still very happy with this as a successful criteria, both for IDOX Group, but also for potential sellers. So again, in summary, looking for smaller owner-managed businesses that have typically reached our inflection point where they have a decision to make around the need to put additional investment into the business, whether that's external investment or from their own resources. And we think we have a very strong proposition to provide an alternative to that. With our scale and public sector market positions, we can provide immediate support in terms of go-to-market. We can bring experience and actual account management contacts to some of these businesses very quickly, and as well as that, just help with the operations and back office. In many cases it's completely removing the back office. In other cases, it's helping to optimize operations, such as maybe taking support overhead out of the development team, so the development team can focus exclusively on product management and delivering product, etc. And as I mentioned earlier on, the model has proven to be very successful for the sellers, whether they're staying in the business to continue the journey with IDOX, both in respect of the acquired business, but also to help with the IDOX effort more generally, or indeed whether the plan is for them to exit as part of its succession plan, which is the case with exegesis, by the way. They've been very clear with that. Again, we feel that IDOX is a very good home for those businesses to take them on. So in summary, no change to target profile. We're really pleased with how the efforts are going, and of course, especially pleased with the 3 that we completed in FY21. Of course, now we look to FY22 for the next ones. I'll pass back to you. Thanks, Dave.
Great, thanks, Rob. I was reading a report this morning that said 1 in 3 councils doesn't have a plan in place to deal with the climate crisis. Our experience of dealing with the public sector generally is that they are very determined to see that they're working with responsible clients, and indeed, in terms of their own local initiatives of community engagements, many of these things are playing an increased prominence in their decision-making activity. So it's something we take very, very, very seriously. So in FY21, we formed the ESG steering committee that's run by Noble. I'm a participant in that, but fundamentally we're there to set out our performance goals and targets. And in our annual report this year, you'll see that we've adopted the TCFD reporting guidelines, and we've also then tried to put all of our initiatives around our people, communities, environment, and our organisation responsibilities in line with the SDGs that are, I think, categorized under each of those areas. So the UN SDGs that we support are clearly identified as we run forward with our ESG responsibilities moving forward. So I think collectively that provides a really solid platform for IDOX to embrace the work that's going on around ESG. And as I said, as well as doing the TCFD frameworks, we're also meeting requirements to streamline energy and carbon reporting regulations and working within the 3 scopes of the greenhouse gas protocols as well. So we've made a commitment to being net zero carbon neutral by 2040. And as I say, I'll just guide you to the annual report where you'll be able to see the goals and the targets that we've set out there for the forthcoming periods. But the main aim with this is, I think a lot of organisations are concerned and worried that this is a sort of extra administrative burden on their business. We take the approach that says, look, it's just part of our ongoing day-to-day activity. So, we always say at IDOX, we're not average people, we're extraordinary people. So extraordinary people grab hold of these things and embrace it as part of their normal operating activity. And that's the approach that we've taken. So you'll be able to see some very positive engagement on that for us as we move forward. So very quickly and in summary, our markets, software solutions, high levels of recurring revenue provides a lot of resilience for the business. We've got strong recurring income and a good order book, which provides great visibility to earnings. The sales pipeline remains positive. It's in line with our budget assumptions and our expectations for this year. The acquisitions we made, as Rob's described, are integrating well into plan. And I think we've got a reasonable level of ongoing M&A opportunity. We continue to work hard at that, but we would expect to do well with that as we go through the course of FY22. And as Rob pointed out, we're absolutely in line with our expectations and trading for the current year. So we're really well positioned, we think, for our fly stage. We're looking forward to the next 12 months and creating some more value for customers and shareholders. And with that, we're going to draw a breath, and Rob and I would be very happy to take any questions that you might have of us.
And we've got a question from Steve Robertson from Canaccord.
Are you at all worried on the weaker order book at PSS year on year? Now, I appreciate the absolute number is small-ish versus the overall group turnover number. But that's my first question. And then my second question, and you've gone through the acquisition strategy, but are larger acquisitions possible? And I guess by larger, I'm talking sort of 25 million and up. And have you looked at anything of that size? Those were my two questions.
Just on the order book, morning, by the way, Steve, good to hear from you. Thanks for the question. So there have been a couple of very sizable projects in IDOX for a few years now, actually. We've referenced previously the Metrolinx transport project over in Toronto, Canada. Last year, I'm pretty sure we announced the Scottish E-Count win. And both those contracts are sort of multi-million-pound contracts for us. And then we have a slightly, well, it's unusual, but those are the only 2 big contracts at IDOX by quite some distance. We then have, a very high volume of typically smaller orders. And so the decrease in order book is simply a function of delivery under those 2 contracts. So the Metrolinx contracts we've had for 3 or 4 years now. The Scottish E-Count we've had for about a year, I think. And so on contract, the order book jumped up significantly with those 2 entries, and as we're delivering them to plan, it's just come down as planned. If you were to strip out those 2 large items, the underlying order book is actually consistent year on. In fact, I think it's up slightly, given some of the increased order intake we've seen.
In terms of acquisition, Steve, yeah, I mean, we, as you know, we're quite ambitious people. We like to be slightly understated, but that should never hide our ambitions. I think the important thing for us with the acquisitions is that we felt we were in the right organisational shape to be able to absorb, demonstrate to shareholders that we're a good place for these types of assets and we can deliver better outcomes with them being part of the group. And I think, as you saw with the disclaimer slide, we're doing that. And I think as we've prepared ourselves organisationally, we feel we have the capacity and the capabilities to take on larger deals. So we're certainly not excluding those. We think we found a good niche that offers opportunity for us to, continue to add to the portfolio by using our own cash reserves. And I think as we go forward, I hope, that will give everyone confidence that, that there are larger deals that would make sense for IDOX that we also could be entrusted to go and execute on. So we always have a watch and brief on those things, and they get quite a lot of debate on a regular weekly basis. So we're definitely not shy to those things. We just want to make sure that they were the right things at the right time.
And we'll go to George O'Connor at Stifel.
As we think about Fly, 2 quickies from me, please. Do you have any amber lights on your dashboard, or as Rob would draw, incomplete circles? And then secondly, as we think about non-recurring in PSS, and comments in there around term licenses, is this a reflection of residual technical debt in there? Is there sort of a product roadmap to bring those to subscription and recurring products? Thank you.
In terms of amber lights, we're constantly running our assessments of the business, and we're a fully risk managed business, so in that sense, so very mature company in terms of thinking about our markets, our customers, our product sets, and the suitability, the competition, and all of those things. I would say that we're constantly thinking about the market spaces in which we operate. We're sort of conscious that the public sector has a lot to do, and certainly through COVID, it's been a challenging time for clients. They're constantly under pressure, working from home, and adapting to new models of working has been awkward, remembering that often they're dealing with very complex issues. And their ability to absorb change can just be diminished through environmental activities that are outside of their control. So, our aim during this period is to make things as easy as possible for our customers and support them as well as we possibly can, and offer them easier and smoother transitions into cloud and SaaS as we go forward. The Log4j thing that happened last year was, yet another one of those things that sort of added a further burden of activity to a lot of customers, and we were just keen to be able to help clients. Not that there are any issues with the things that we're providing and doing, but we just wanted to make sure wherever possible that we could help and assist on those things as we go. So I think, in terms of amber lights, I don't think it's an amber light, but I think it's the one that always, comes to mind, is just making sure that, the market condition under which we're operating is appropriate, and we're dealing with it in exactly the way that, we ought to for a company of our stature.
In terms of sort of levels of recurring revenue, I think that partly answers some of it as well, actually. I mean, we've been very clear for a few years now that various parts of the portfolio are on the journey to cloud at slightly different speeds. Some are there, some are on premise, and various sort of shades of grey in between. And the big one for us are sort of moving from a very, very well established sort of local authority regulatory services business to what was Tascomi, now IDOX Cloud. And for all the reasons that Dave just described there in terms of speed of change in the market, we've been very clear all along that is definitely a multi-year exercise. We're more than happy to continue to support customers wherever they are on that journey, whether they, for whatever reason, need to continue with an on-premise deployment through to whenever they are at the point that they're able to move through to cloud. So none of that's changed, but very, very much, continuing on that sort of longer term trajectory. The only other thing I'd just flag specifically on the results in FY21, we talked about it quite a bit at the half year, but less so now. Less of the full year, actually, just because the impacts averaged down a little bit. But we did see a few sort of noticeable things that just held back our recurring revenue slightly in a few different parts of the business. There was sort of a couple of discrete pockets, so notably EIM for the reasons that we talked about before, and also they had a couple of sort of client-side corporate activities, one of which was a bankruptcy, unfortunately. And then we also saw some much slower, in fact, small decreases in our social care and some of our sort of health type activities. Again, just as activity customer side was slowing down a bit. It wasn't anything to do with sort of competitive losses or anything like that. It was more the market conditions and our ability to sell more into those markets. For all the reasons discussed, as things are settling that down a bit more now in those respective markets, we feel very well positioned for that going forward. So, we're much more hopeful, stroke ambitious, stroke planning for increases in year-on-year organic recurring revenue rates along the lines of what we've guided for PSS overall, i.e. mid-single digits.
We'll go to James Lockyer from Peel Hunt.
A couple of questions from me, please. It'd be good to hear a little bit more about the Pune activities and the outsourcing there. You mentioned it's half of the hiring plan for 2022. How might you be able to leverage that further as you continue to expand and see more operational efficiencies? Is there the opportunity to move more costs out there? I guess that's question one. And then secondly, in terms of upsell and cross sell, that's obviously one of your fly optionalities going forwards. How much of this is currently self-serve or could be self-serve for existing clients, which might actually mean that costs for upselling is low, and is there more opportunities you move to the IDOX cloud to hence see margins higher still? Those are two for now. Thanks.
I think in terms of Pune, just very keen to bring together our offshore activities into one coherent centre. I think the advantages of doing so are pretty self-evident. But one of certainly as I've built that kind of operation in the past, one of the things that you really gain through a bit of scale and size is to be able to put in place all the support capabilities that you need to run a successful operation in India. So, you need to build up, your HR, your finance capabilities, your administrative functions. And by doing so, you're also then able not just to have it as a development centre, you can offer it as good administrative support. You can do products engagement and management activity from that location, but also be able to support, your clients around the clock when it comes to technical capabilities and all sorts of other things. So, bringing it together has allowed us to assess what the potential for that business might be going forward, and to feel confident that with the right people managing that business for us, it will be able to be a really productive part of the group. And so that's turning out. So, I think your comment about operational leverage is right. We can see the ability to just have some balance by offering that capability out there. But also, probably most importantly, right now is just also having the ability to supplement skills when we need to. Skills are in high demand, and whilst here at IDOX, because of all the work we've done around people over the past few years, I think we've got lower than average attrition in our sector by a long way. We are conscious that as we grow, we need to have access to capabilities and skills that might be restricted here in the UK. So building out that operation, I think, is really important for us over the course of the next 12 months.
Just on the second question, James, I know we touched on upsell, cross-sell before. It undoubtedly is an area of focus for us. I think if we were to sort of reflect over the last 2 or 3 years, there has been upsell, cross-sell, where there's a sort of immediately obvious question to answer, but whether we've been quite as sort of proactive on that, I think it provides an interesting opportunity going forward, actually. And as I sort of mentioned in some of my comments in the presentation, we're in a really good place now. We've made really good progress with the sales stratification that we sort of cited previously, with new inside sales desk and revenue assurance. So well placed to run campaigns to really ensure that the customers are aware of the full suite of IDOX products. And of course, that applies even more so as we keep going with our buy and build and bring more product sets into the group, both selling IDOX into those customers and obviously vice versa. In terms of the self-service element, I mean, I'll defer to Dave, but nothing immediately I'm aware of. I think the majority of our solutions, certainly in the land and property, local government, regulatory service, are typically sort of solution-led and do sort of require a fair degree of sort of specialism, quite frankly, from our staff, both in terms of understanding the regulations as well as the actual sort of project management aspect of deploying software. So I don't see that changing in short order. I mean, as Dave mentioned, we've done quite a bit of work on improving data mapping tools, which makes those sorts of things are a little bit easier. But I suspect we're a little way off of sort of self-service on the SaaS platform, just by virtue of what some of the things we're doing are on those platforms.
And okay, maybe just to follow up, you mentioned over the next few years they may be restricted on skills, and that hence the Indian operation is good there. But I guess any sort of thoughts on inflation or wage pressure that you're seeing or not seeing at the moment?
Well, I think for us, we've had a well-planned and I think well-executed view for our teams as to what they could expect in terms of salary increases. We'd laid that out pretty early on. I did this sort of triple lock. Always a bad thing to mention when you deal with government, triple locks, right? But we did do that handshake with people that said that we wouldn't go back to paying dividends unless we could make salary increases part of our norm, and people wouldn't get salary increases unless we could get back to dividend payments. I mean, I think that makes good sense for everyone. So we've implemented reasonable pay increments across the business. But as you know, there are certain parts of the market that are under enormous pressure for talent and salaries at the moment. We're not going to get caught up in that. We think people work here at IDOX for lots of reasons. Pay is one of them, absolutely important, and it's right that we should be competitive on salaries. But at the same time, it's absolutely right that we also manage and control costs, and we give people career paths and futures. And I think being part of a growing business that is focused around IP is also very attractive to people as well. It still remains that way. So I think the building up of our offshore capabilities allows us to have some mitigation against excessive pay increments and allows us to control things a little bit. But its principal activity during the course of the next 2 years will definitely be support growth in the business for sure.
And we'll go to Ian Robertson from Progressive Research.
Hi guys, great set of numbers. I'm just sort of going to ask a bit of a technical question. I'm trying to understand about the database behind all this. I mean, to what extent are you building? Have you got several databases, or to what extent have you just got one? And every time you're acquiring new business, you bring it into your existing database. And also, following on from that, on the sales process cycle, is it shortening, lengthening, any change at all in the way in which councils are behaving? And does having more things to offer them change the way in which you have to sell to them?
Thanks, Ian. Morning. Hope you're well. On the tech side, by its very nature, IDOX is a business that's come together with a range of different technologies. So there's no one underpinning technology database that supports every activity that we do. However, within the business, and certainly one of the fundamental principles that we've adopted during the course of the last 3 years has been to narrow the technical focus of the business in particular areas, so that we have more continuity of operating environments and for our existing customers. So certainly in the IDOX cloud, we've absolutely narrowed to the work that we did with Tascomi, the social care new product suites that were pushed out during the course of FY21 had all been repositioned and rebuilt under that platform. So that's our sort of standard go-to in that environment. And in other areas, we just narrowed some of the technical choices that had historically been made, upgraded them to make sure that they were more common and more appropriate for customers as they went forward. So that's on that one. In terms of sales process, I guess depending on where I started on the circle, I could give you a few different answers. I think the upshot is that in general, sales processes have remained fairly resilient and in accordance with what we would have expected. There have been a few that have maybe been deferred and delayed, others surprisingly that accelerated during the process that we haven't anticipated. So, but generally speaking, I think they've been pretty robust, which has been quite remarkable, as I said earlier, given the levels of pressure and other things that our clients have had to endure during this period. But we haven't noticed anything too challenging on that. What I would say, and going back to Rob's comment and the thing about cross-sell and upsell, is, we feel one of the real advantages for IDOX is that, we're doing important things for clients. We have software that matters in how they perform their day-to-day tasks and important legislative and regulatory activities. And because of that, we always have a reason to be in contact with them. Whether it's through our support desk, through our professional services group, through our sales teams, our customer success teams, there's always a reason for us to be in contact with them and understanding what their requirements are, what their needs are, and what assistance we can give them. And we think that's an advantage right now, because if you're out there with a great new proposition that's world beating and all the rest of it, that's great, but you do have to get people's attention for that. And I think with everything going on, that has been quite challenging if you don't have that surrounding engagement with customers that you've established over a period of time. So that's certainly been helpful to us, and I think absolutely was fundamental in us improving the way that our professional services activity delivered during the course of last year, and the amount of work that we did for customers on that basis. I think they were key drivers there.
Many thanks, and that's the end of questions. David, do you have any closing remarks?
Well, I just thank you for your continued interest in the business. I mean, we definitely, as you know, we always enjoy getting together with you and giving you an insight to our thoughts on the strategic nature of IDOX and its transformation. So thank you for that. We still believe that this business offers a great investment thesis. I think it's really solid recurring income through long-standing relationships and client engagements, which is producing great cash outcomes and able to fuel further inorganic growth in the business through further M&A. So thank you for taking interest, and as I say, I think we believe we've got a really strong proposition for improving shareholder value as we go forward. Thank you.